Hello and welcome to the Global View on this Thursday. Well, Washington's legislative paralysis has been resolved with the US House of Representatives electing Republican Mike Johnson, a conservative with little leadership experience, as Speaker. Democrat President Joe Biden's $106 billion spending request for aid to Israel, Ukraine and US border security has been stalled in the absence of a Speaker. Well, the US 10-year Treasury yield climbed on data showing accelerating new home sales in the States in September, which affirmed market expectations of interest rates being higher for longer. The yield on the 10-year Treasury note up 6 basis points to 4.9%, the 2-year at 5.09. And the US dollar rose to a near one-week high against most major currencies as investors' appetite for riskier currencies faded. The Canadian dollar weakened after the Bank of Canada held its key lending rate at 5% as expected, and forecast weak growth while maintaining its option for more rate hikes to tame inflation. The Aussie dollar trading, it's taken another leg lower, currently now under 63, 62.9 US cents. Let's now turn our attention to India and I guess how it compares particularly with other emerging markets. To talk us through that, Mugunthan Siva, Managing Director, India Avenue Investment, joining us now. Mugunthan, good to see you again.
Yeah, likewise.
All right, well, I think we spoke about this last time, just in terms of those valuations we're seeing in India at the moment. Regarded perhaps that the overall market is somewhat overvalued. Is that still the case?
Yeah, look, I think when you're putting it relative to other emerging markets, it certainly stands out like a sore thumb in terms of its valuation at the index level, particularly when compared to, say, a China, where there's been some hardship.
Well, let's, in fact, see how this is panning out on the charts. We'll bring up the MSCI for India. They're outperforming just in relation to emerging markets. What are you seeing here then?
Oh, look, over the last 10 years, we've seen a 200% outperformance of India versus the broader MSCI emerging markets. And that's been driven by, India's earnings growth, really, which was lackluster last decade, but has certainly, increased to a pace of about 15% this decade, and a strong recovery post-COVID.
Yeah, we might bring up the next chart too, which is that price to earnings in relative terms then.
Yeah, you can see that over the last 10 years, the average is around just over 70%. Prior to that, it would have been as low as 40 to 50%. And right now, India is trading at a significant premium to the broader pack. Two reasons. One is India and the other is China.
So, if you're looking to invest in India, where are you looking then, given what we're seeing more broadly at the moment?
Yeah, look, I think if you're looking to invest in India, the long term still looks to be a tailwind, even at these sort of valuations. And that's largely because we've shifted paradigms this decade post-COVID in terms of earnings growth. And that's being driven by improved productivity, increasing infrastructure, things that weren't there in the last decade, where it was driven more by consumption and finance. We're seeing it being driven more by private capex, infrastructure, manufacturing, which tends to have a multiplier effect on the economy and earnings growth.
You did note that we have seen inflows, particularly from Japan and South Korea, into India. Why is that?
Look, I think it stands out, 7.8% GDP growth. The IMF, the World Bank are forecasting somewhere between 6.3 and 6.5 for this year and onwards. And the Central Bank of India is forecasting 6.5. So that stands out relative to the rest of the world. So money flow has come back to India after last year's episode of, higher rates, higher inflation, rising oil prices. Investors took a break from India and tried to play the China reopening trade, but that's kind of reversed in the post the first quarter after the Adani episode in the Indian markets.
Yeah, all right. Well, Mugunthan, you talk stocks specifically. In fact, I'm just taking a look at the top 10 market cap there, dominated by the Reliance Industries, the conglomerate, is on top, particularly in the oil space as well. You do have IT, which is unsurprising, plus banking. Let's begin with banking then, what we're seeing in that sector.
Well, if you go back 5 years ago, Indian banks were in a pretty torrid state in the sense that non-performing loans had hit a high of 11% of the system. There was a bankruptcy act put in place that has led to non-performing loans dropping to around 5%. Banks have got their act together, credit growth has improved, net interest margins are strong, and risk-taking has been curtailed to some degree. We know that there will be some problems globally for banks going forward, given the economic conditions we have seen. But Indian banks are, really enjoying their time in the sun at the moment, and valuations are still supportive, given the base they came from.
Elsewhere, I see, in fact, at number 2 is Tata Consultancy. So this is a spin out from Tata. It's what a IT consultancy, business solutions and the like.
Yeah, it's India's largest IT outsourcing firm, along with the likes of Infosys, Wipro, HCL Technologies. They're the big 4 in India. So Tata Consulting, Tata Group as such has several companies. One will be Tata Consulting, there's Tata Motors, there's Tata Steel, and so on. And the group company owns a stake in all of these as the founder promoter. So this company trades at enormously high multiples, but that's because the quality of its earnings growth and its return on equity has been pristine.
What's going on with Tata Motors at the moment? Because obviously we've seen what China is doing, particularly in EVs. It's proving to be highly competitive given the price point that they're exporting their vehicles. What's Tata doing?
Yeah, so look, firstly, India's one of the largest markets for autos in the world, and post-COVID, it really limped into COVID, this sector, because demand was weak. Then there was the supply chain shocks, and Tata Motors was at the epicenter of this. They own big brands like Land Rover, Jaguar, globally. And also exposure to China. So in that came a bit of weakness in the stock due to these supply chain issues and weakness globally. But what we've seen is a strong recovery from a low valuation. So this company has gone down the EV path, is launching vehicles. India's EV penetration is rising quite rapidly, and we do see a bit of an S-curve in that coming forward. So the stock has done about 50% in the last 12 to 18 months.
Now, also there's a couple of consumer goods stocks there, Unilever among them. What are we seeing with the Indian consumer at the moment? Given how the economy is tracking, cost of living pressures, well, that's a factor globally at the moment. How is the Indian consumer faring?
So far, okay. The last couple of months are starting to show some signs of, pressure on the consumer. But prior to that, really, I guess India's economy had been chugging along reasonably. One thing that's important to recognise is 5 to 6% inflation in India is pretty much the same as what it's been on average for the last 25 years. So rates are not astronomically higher than where they were in the past. Whereas for the Western world, there's a huge difference in what rates you're paying now versus what you were. So from that perspective, the Indian consumer has been mildly affected to date, but if the rest of the world continues to slow, some of that will get passed on through the fact of exports slowing down and wealth starting to reduce for corporates and perhaps for some consumers as well.
If we make a comparison with China, of course, the middle class, it's really what has driven that growth we've seen in China. Are we seeing that in India? A lot of comparisons, of course, made between what we've seen in China and what's ahead for India. Is that likely to pan out, do you think?
Well, 16 years ago, China's GDP per capita is where India's is today. China went ahead leaps and bounds by moving people from rural locations to the cities, building a widget, making money, becoming wealthier, going into the middle class. In India, urbanisation is one of the lowest of all the major countries at about 35%, and GDP per capita is still only around 2,500. So well behind China's 10,000 plus. So that is still to come, to answer your question. And really, when you get to GDP of GDP per capita of 5,000, then you become a consumer economy. Right now, only 25% of people have a fridge, and only 15% have a microwave. So that still hasn't played out.
And so is that possible that you're going to need further large structural changes to the economy, which of course I guess easier said than done in China because it's a command economy, whereas it is an open economy in India. Is that therefore much more difficult to engineer?
Yes, it is. There's a massive amount of spend on infrastructure that's happening and forecast to happen over the rest of this decade, something like 2.5 trillion Aussie, which is well over the size of the Australian economy. Infrastructure is really the conduit to urbanisation, efficiency, reducing your logistical costs, reducing the cost of doing business. All those things will have a significant and profound impact on GDP per capita lifting over time.
Mugunthan, great to get an outlook on what's ahead for India. Thanks for joining us from India Avenue Investment Management.
Thanks very much.
All right, that is the global view on this Thursday. A quick check of the market. We're just a couple of minutes away, of course, from the open here locally. We are expecting a lower open. We don't know the chart, but it's we're about 0.25% off on ASX futures. Stay with us for the open.